Imagine this. The US government runs out of money to pay its bills. It can't borrow more because it has reached its legal limit. It can't raise the limit because Congress is deadlocked. It can't print more money because that would cause inflation. It can't default on its debt because that would trigger a global financial crisis. Sounds like a nightmare scenario, right? Well, it could become a reality very soon. In this video, we'll explore what the US debt ceiling is, why it matters, and what could happen if it's not raised or suspended in time. The debt ceiling is the maximum amount of money that the US government can borrow to pay its bills. It covers things like interest payments on debt, social security benefits, military salaries, healthcare programs, and more. If it's not raised, the government will not be able to pay its bills, which could lead to a default on its debt. This could have serious consequences for the US economy and global financial markets. The current debt ceiling crisis is caused by political disagreements between Democrats and Republicans over government spending and taxation. Democrats want to raise taxes on the wealthy to pay for social programs, while Republicans want to cut spendings and reduce taxes. The situation is complicated by the fact that Democrats have only a slim majority in Congress, which means they need Republican support to pass legislation. However, Republicans have refused to support any increase in the debt ceiling without significant spending cuts. The stakes are high and both sides are under pressure to find a solution before it's too late. If they fail, it could have serious consequences for the US economy and global financial markets. In the United States, the Congress comprising the House and Senate approves the budget and funds for the executive branch to run the country. The issue of debt ceiling arises from the fact that United States has been running a fiscal deficit since 2001. Since income of the government is less than the expenditure, the government has to borrow to function. There is a limit to that borrowing which is periodically increased to allow the government to borrow more and continue working. If the debt ceiling is not increased or suspended, the government would not be able to borrow and pay its outstanding dues. So far, such a situation has happened only once, and that too from an accounting error and not a political crisis. According to CNBC, the US has defaulted on its debt just once before in 1979. A technical bookkeeping glitch resulted in delayed bond payments, an error that was quickly rectified and only affected a small number of investors. The debt ceiling was created by the Second Liberty Bond Act of 1917 and has been raised or suspended 98 times since then. The last time it was suspended was in 2019 until 2021 under President Trump. Since then, the Treasury Department has been using extraordinary measures to keep paying the bills, but those measures will run out soon. The Congressional Budget Office estimates that the US will run out of cash by mid-October or early November. If that happens, the US will default on its debt for the first time in history. This means it will fail to pay back its creditors, who are mostly foreign governments and investors. This could have serious consequences for the US and the world economy, such as higher interest rates. The US would lose its AAA credit rating and face higher borrowing costs. This would make it harder to finance its spending and service its debt. It would also raise interest rates for consumers and businesses, making mortgages, car loans, and credit cards more expensive. Lower growth. According to Moody's analysis, the US economy would shrink by about 6% and lose about 7.8 million jobs. This would push the country into recession and hurt consumer spending and business investments. It would also reduce tax revenues and increase the budget deficit. Market turmoil. The US dollar would lose its status as the world's reserve currency and face a sharp decline in value. This would make imports more expensive and exports less competitive. It would also trigger a sell-off in the stock market and wipe out $10 trillion in household wealth. Global contagion. The US default would send shock waves across the global financial system and disrupt trade and investment flows. It would also create uncertainty and panic among investors and consumers worldwide. It would hurt emerging markets and developing countries that depend on US aid and trade. But why does this matter for the rest of the world? Why is everyone so dependent on what happens in Washington? Well, that's because of the unique role of the US dollar as the dominant currency in global trade and finance. The US dollar is used for more than half of all international transactions. It accounts for about 58% of all foreign exchange reserves held by central banks around the world. It is also widely used as an alternative currency in some unstable economies where people prefer dollars over their own local money. The dollar's dominance gives United States enormous financial power and influence over other countries. It also makes it easier for United States to borrow cheaply from abroad and run large trade deficits without facing much pressure to adjust its policies. But this power comes with responsibility. The US must maintain its credibility as a reliable borrower and payer. If it fails to do so, it could undermine confidence in its currency and its leadership. The dollar's dominance would also mean that any shock or crisis in United States can quickly spread to other countries through trade and financial channels. For example, orders for Chinese factories that sell electronics to United States could dry up. Swiss investors who own US Treasury would suffer losses. These are just some examples of how a US default could affect different countries around the world. No corner of the global economy would be spared if US crashed into recession. The dollar's dominance is not guaranteed forever. In recent years, some countries have tried to reduce their reliance on dollars by using other currencies such as euros or yuan for trade and investment purposes. Some countries also resent on how United States uses its financial clout to impose sanctions against rivals and adversaries. But so far, no clear alternatives have emerged. The euro lags far behind the dollar in global usage. The yuan is hampered by China's tight control over its currency market. Other currencies are too small or too volatile to challenge the dollar's supremacy. But if US were to default on its debt without resolving it quickly, it could accelerate these trends and erode its financial power over time. The global economy is already facing many challenges: surging inflation, rising interest rates, geopolitical tensions, authoritarian regimes, and environmental threats. Adding a US default to this mix would be incredibly irresponsible. That's why we hope that United States political leaders will find a way to avoid this disaster before it's too late.